Welcome to the D-Risk Daily Brief. It's Monday, November 3rd. The theme today is a fragile rally in a data vacuum. U.S. futures are pointing to a positive open, with the Nasdaq leading the way, continuing a trend we saw overnight where equity indices from Tokyo to Frankfurt are flashing technically bullish signals. On the surface, it looks like risk-on sentiment is firmly in place. But beneath that green screen, the story is much more complicated. The U.S. government shutdown is now entering its fourth week, creating a critical data blackout. We have no official read on inflation. And perhaps more importantly, the Federal Reserve just injected nearly $30 billion into the banking system, the largest liquidity operation since 2020, in response to bank reserves hitting a 4-year low. So Alex, we have this clear divergence, bullish charts on one hand, and signs of serious economic and systemic stress on the other. How are traders supposed to navigate this?
It's a great question, Sarah, and it really forces you to look past the headline indices. Let's start in Asia, which sets the tone. The Nikkei is in a powerful uptrend, well above a golden cross. But the fundamental driver there is getting complicated. Tokyo's core inflation just accelerated to 2.8%, well above the Bank of Japan's target. Governor Ueda is sounding increasingly hawkish, and the market is now seriously pricing in a rate hike, which would be a major policy divergence from the Fed. The Hang Seng is showing similar technical strength, but it's operating in the shadow of those conflicting U.S.-China headlines, official optimism versus persistent underlying tension. Then you cross over to Europe, and you see the exact same pattern. The DAX and FTSE 100 are both technically strong, but Germany, the continent's engine, is shrinking. The IW Institute reports over a third of German companies plan to cut jobs next year. That weakness puts the ECB in a very difficult position, holding rates at 2% while its largest member economy is in a clear downturn. This brings us to the U.S., which is the epicenter of this whole dynamic. The Fed's second rate cut was one thing, but the massive repo injection is another. That wasn't a proactive move to stimulate growth. It was a reactive move to shore up the financial plumbing. That tells you there's stress under the surface. This tension is playing out across every asset class. In the bond market, the MOVE index, which tracks Treasury volatility, has climbed to 115. That's a sign of deep uncertainty. The market is pricing a 71% chance of another Fed cut in December, but without CPI data, it's all just speculation. The US dollar index reflects this paralysis. It's technically in a long-term downtrend. A death cross is in effect, but it's holding steady around 99.50, caught between the Fed's dovish actions and its cautious language. In commodities, you see a flight to safety. Gold is trading firmly above $4,000 an ounce, benefiting from the softer dollar and the general sense of unease. Crude oil is the one outlier, rallying toward $61 on the OPEC Plus decision to pause output hikes. But even that rally faces headwinds from the weakening demand picture out of Germany. And finally, the VIX is still relatively contained around 17.5, but it's ticking higher. So the Fed's liquidity is the primary fuel keeping this equity rally going, but we're flying blind into a zone of real economic turbulence. Back to you, Sarah.
So the key takeaway is that markets are running on central bank liquidity while largely ignoring, or, because of the shutdown, being unable to properly see the economic warning signs. With that official data vacuum, today's private sector releases become even more critical. All eyes will be on the U.S. manufacturing PMIs from both S&P Global and ISM, due out later this morning. They'll give us the first real glimpse into the health of the industrial economy for October. We'll also be parsing every word from a series of central bank speakers. In Europe, we have the ECB's Lane and Escriva, who will likely be questioned on the German slowdown. And in the U.S., we'll hear from the Fed's Mary Daly and Lisa Cook. Their tone on future policy will be scrutinized intensely, especially as the market's rate cut expectations diverge so sharply from the Fed's official wait-and-see stance. It's a day where the qualitative signals might just matter more than the quantitative ones. We'll leave it there. Thanks for listening to the D-Risk Daily Brief. Disclaimer: this podcast is for informational purposes only and does not constitute financial advice. All investment decisions should be made with the help of a professional.